Good morning, everyone, and welcome to this special due diligence webinar. The format for today is a presentation with Q&A breaks throughout. We want to make the event as interactive as possible, so please ask questions via the Q&A box at the bottom of your screen. Today, we'll be discussing the WAM Alternative Asset Fund, ASX code WMA. WAM Alternative Assets is the only listed investment company on the ASX that offers access to a diversified portfolio of alternative assets, which are typically accessible only by institutional investors. The company's investment objectives are set to consistently deliver absolute returns through a combination of dividend yield, capital growth, and providing diversification benefits. Our presenter is Portfolio Manager Dania Zudorova, who oversees the fund. Dania has held senior roles in Australia, the US, Europe and the UK throughout her 24-year career. Before joining Wilson, Dania most recently held the position of Director of Manager Research in Australia and Head of Real Estate Assets Australia at Willis Towers Watson. Prior to this, Dania held various real assets investment roles with Willis Towers Watson in London and New York. It's my pleasure to welcome Dania, and without further ado, over to you.
Thank you very much, Paul, and good afternoon, everyone. Before I start with my presentation, just to note, please familiarize yourself with our disclaimer. And to begin with, I am sure most of you will be familiar with Wilson Asset Management, so I will make a brief introduction to our business, and we'll have an opportunity to do a short Q&A after this section. The business was established by Jeff Wilson over 25 years ago with a focus on managing listed investment companies. We currently manage 10 LICs, and most of them are focused on equities with various strategies, including Australian and global equities. WMA is more of a recent addition to the business. We took over the portfolio management rights for this LIC in October 2020 and have been managing the LIC since then. We have a strong focus on delivering best investment results to our shareholders. We manage about 5 billion assets under management on behalf of over 130,000 retail shareholders, and have investment team that consists of 16 investment professionals focusing on their respective strategies and managing the LICs with Wilson Asset Management. I'm just going to pause and see if there were any questions on Wilson Asset Management or on the team.
Look, I've got one quick question to kick things off, Dania, and it's where do the constituents of the fund mainly come from, and is it predominantly S&P ASX listed names?
Is this question, Paul, specifically on WMA or broadly on?
I think just more broadly from what I can see, Dania.
Yeah, so most of the LICs within the equities, they are focused on the Australian market. We have one global strategy that is managed by the team based in Sydney, and then the lead portfolio manager is based in New York. So that's basically the global markets that they're looking at. We also have two LICs within Future Generation. Future Generation is an investment platform where investment managers manage the capital pro bono, and so do all the service providers. And then 1% of the revenues from Future Generation is donated to a number of charities that we support. So since inception, I believe the number is over 60 million has been donated to various charities. So very strong, purpose-driven proposition for our shareholders.
Yeah, absolutely. That's a large number. That's all the questions for now. So we'll let you continue with the presentation.
Thank you, Paul. So to begin with WAM Alternative Assets, to me, I'm very excited about this opportunity to bring the portfolio of high quality alternative assets to retail shareholders. And as Paul mentioned in his introduction, I spent most of my career investing across alternative assets and investing on behalf of institutional investors. So I've seen throughout the career that alternative assets play an important role within any investment portfolio. And the reality was that for retail investors, it's been historically an asset class that was very difficult to access. So WMA, to some extent, solves this challenge. It is indeed a unique proposition. Most of our peers that you'd see within similar structures, be it LIC or LIT and listed on ASX, they do tend to focus on one specific strategy within alternatives. Examples would be private debt, or private equity, or water rights. WMA is the only portfolio that has the flexibility and quite a broad mandate to invest across asset classes. And I'll talk in more details in terms of the examples and the strategies that we've been investing in. The company's objective is to provide those diversification benefits to our shareholders and to bring those strong complementary benefits of alternatives into the portfolio, and also deliver capital growth over long term and deliver fully franked dividends in a fairly consistent manner for our shareholders. When we talk about alternative assets, without going into the details, it might often come across or sound as something risky and something unknown. The reality is we do see those businesses and assets in our day-to-day life. Most of them can be considered essential businesses or essential services. In terms of the specific strategies, I look at private equity, infrastructure, real estate, real assets that might include water rights, agriculture, and some other strategies, and then private debt. And we'll talk about some of the examples across the strategies. Most of the portfolio also is invested in Australia. We do have some inherited assets that are outside of Australia, but overall, the exposure to overseas assets is within 10% of the total portfolio. Why I am so excited about WMA and in general about alternatives. You do see, I'm sure, a lot of other strategies in the market, and there is probably more attention from wholesale and retail investors towards those asset classes. When we look at institutional investors, and even let's take example, our future fund, Sovereign Wealth Fund, they've been investing in those asset classes for over 20 years. And most of the institutional investment portfolios would have an allocation to those asset classes that would range 20 to 30%, in some cases even higher. And this is because those asset classes do bring those complementary benefits. They have strong diversification benefits. They provide opportunities to invest across various long-term themes that we see across different sectors. They do tend to have quite different risk-return characteristics versus more traditional asset classes. And the LIC structure provides even further benefits in the sense that retail investors can access those asset classes without worrying about illiquidity, because the reality is when we invest in private equity or infrastructure or other asset classes, we are talking about investment horizon of 5, 7, 10 years, sometimes even longer. So listed investment company structure provides this fairly easy access to retail investors without requiring like illiquidity budget for this type of the strategy. As I mentioned as well, given the structure, a lot of focus is on income and what dividends we can produce for our shareholders. It's quite an important characteristic of the listed investment company and is very appreciated, in particular when it's fully franked dividends. With WMA specifically, there is also an opportunity to buy shares at discount to NTA, and the discount will be narrowing. So from the total shareholder return perspective, it's also an attractive structure for many investors in the Australian market. The way I assess the opportunity set within those asset classes, and it's a very broad opportunity set, very unique asset classes. Each of them have specific dynamic, have specific risks, have specific trends. And so for me, the starting point is always, what are the investment themes that we are currently seeing in the market? And I want to pursue and I want to focus on the investment themes that have long-term strong tailwinds. In other words, when I do invest in a portfolio company or when I do buy an asset, I want to ensure that underlying market fundamentals are strong, and there is a strong likelihood that in 5-7 years' time, when I am exiting that portfolio company or an asset, the market will be still attractive for potential buyers to look at this type of investment opportunities. So the themes I tend to focus on, and I'm not limiting yourself to those themes, but I think these are the ones that bring quite a lot of deals right now. One is climate change. Second one is growing aging population. Third one is digitalization. And fourth one is growing demand for food. And the interesting aspect with this type of the portfolio that across all those four themes, I can look at private equity, infrastructure, real estate, and other strategies and make a decision which one of them offers an attractive entry point into this specific theme. So as an example, growing aging population has been drawing a lot of attention from many investors. Within alternatives, those opportunities are in private equity, in infrastructure, when we talk about the PPP type of structures, mostly hospitals. There are opportunities within real estate, and it's all about finding those strategies, finding the deals that offer relatively attractive entry point for investors. And I'll give you some more specific examples within the portfolio across those themes. Once the decision is made on the macro level or on the theme level, I then go through a very robust investment process. So if you are an equity investor, you may call this portfolio a high conviction portfolio. I spend a lot of time on due diligence, on average 200 to 250 hours due diligence work on one single strategy before we make the investment decision. And a lot of this is about tapping into the network in the market across the asset classes, generating ideas. Often those ideas come to us. Sometimes we go and proactively approach our network if we're looking for a specific deal or for a specific strategy. And we also have a layer, what I call a layer of devil's advocate, and that's our investment committee. We have high caliber people on our investment committee, including John Roberts, who is ex-chair of Macquarie Infrastructure and Real Assets. Sally Box, she used to be at Future Fund, and she is now at managing director at Cabot Industrial. It's a large global industrial and logistics player. We have Adrian Sue, who spent over 20 years in private equity and more recently at Carlyle, and Jeff Wilson. So to me, it's an important meeting that we have quarterly to go through the portfolio and also introduce and run through the new deals, new strategies that I'm planning to bring into the portfolio. And then the final stage is the implementation once the decision is made. I'm going to pause here, Paul, for questions.
We have questions, and a couple of questions on the floor. I'll kick off with those, and thanks for people for sending the questions through. Question here, WMA appears to be well cashed up. Is this currently working for the portfolio or being held for opportunities?
Great question. We are going to cover it, I think, like in the next sessions, in the next section. So just briefly, it's about 33% of cash that we have in the portfolio. 22.6% is committed. In other words, it's capital that's been already committed to new investment strategies, new deals. So in a way, when we look at the current environment in the market across private markets, I do see it as attractive timing to deploy capital into new deals, into new strategies, because we are seeing that valuations across alternatives started to adjust or normalize. So I'm pretty excited to have this level of cash within the portfolio, but also really excited that most of that cash has been committed. So why I'm excited, because realistically, when you look across private equity, infrastructure, real estate, there are not that many investment teams that are capital raising right now. Most of the capital raising has been done last year. And so what we call dry powder in the current market across private markets is sitting at about 36 billion in Australia now. And this dry powder is being deployed into those deals, into opportunities.
Thanks.
I hope that answers the question.
Cash is king there, Don. Another question here, actually back to about your team. Can you confirm the numbers of your team? And is there a key person risk being yourself in this team, or do you have sufficient support?
Thank you. Great question. So in total, within the broader investment team, we have 16 people. In WMA, I'm the portfolio manager, and I have an analyst who is working with me. The reality is we work as one team. So while I do make final decision on the investment when it comes to macro research or macro discussions, we basically work together with Matt and his team and Oscar in terms of the sources of the information or market contacts. That's, we have access to all of this together. In terms of the more specific deals or questions on valuations, I'd usually tap into Oscar's team because they do tend to invest in small caps, micro caps. So that's the space that would be closer to WMA in terms of the size of the businesses and size of opportunities. And then in terms of the more operational support, we have operational team within Wilson Asset Management. We have finance team who work closely with me. Because with WMA, a lot of work is done on implementation, capital calls or exits. So I have a lot of support within that area. And then finally, as it is listed investment company, there is a lot of work that's being done on engagement, and we have a large corporate affairs team who is supporting me on that front.
Sounds like you're very well supported. Question to here. Do you run any ESG screens over your candidates? And if so, can you give us some details of how you do that?
So, very important part of the investment process for me when it comes to ESG. One component here is from the risk management perspective, it's inevitable to include ESG filters or ESG considerations in the investment process. Why? Because again, we are talking about long-term investments, and in some of the asset classes, such as infrastructure or some sectors within private equity, ESG risks can be quite significant, quite material for those investments. So for me, the starting point, given that I work in a model where we partner with investment teams, the starting point would be learning about their approach to ESG. So part of the discussion would be going through their ESG policy, how they implement it, how they monitor, what sort of reporting they do. And then also looking at their portfolio construction principles, whether there are any hard exclusions, whether there are any specific focus on ESG areas. One of the examples of the investment partners within the portfolio is Adamantium Capital. They have been one of the pioneers in the Australian market in this asset class in terms of bringing very strong practices on ESG front. So that's basically, comes from the type of deals they would source, but also comes from the operational expertise and the strategy that they implement. A lot of focus is on the basically on the environmental component, but then also any factors within the social and governance would have a very strong consideration. And the market has really changed in Australia. So if we look across our new investment partners, Adamantium, Allegro, Palisade, Crescent Capital, all of them have been considering and really integrating ESG as part of their investment process. So again, for me, that's very important. And that would be one of the definitions when I talk about institutional quality investment teams, institutional quality businesses. This is what I want to see within our portfolio.
That's great. It's a very comprehensive answer. Thank you. Just a couple more before we move on. What strategies do you employ to deliver tax-effective income to investors?
The income strategies within the portfolio would be infrastructure, healthcare, real estate, private debt, and water rights. So to me, again, to some extent, it's linked to the structure of WMA as a listed investment company. It's, we are looking at perpetual pool of capital. It's a closed-end structure. And I do want to make sure that within the portfolio, there is a good level of core income producing strategies. So on balance, long-term, I'd expect we'll have about 40% of the portfolio invested in those income producing strategies, and then the rest in growth strategies across different asset classes. So to me, looking at the asset class like infrastructure, so specifically we invested with Palisade, Diversified Infrastructure Fund, and also bought secondary units in the Renewable Energy Fund, which is now has been restructured into a platform. This is a good example of the asset class for any investor where you'd predominantly expect fairly stable, linked to inflation income return. Of course, over time and depending on where we are in the macro environment, you'd expect some capital growth from this type of assets. But when we are talking about mature, established infrastructure within the mid-market segment in Australia, a lot of this is about income return. So specifically on this strategy, since inception, they've been delivering income between 6 to 7% per annum, and then a total return 12% per annum. Very similar story on healthcare real estate. That's, I would consider it income as well, because we are talking about mature assets with weighted average lease expiry on the whole portfolio of over 19 assets now, 10 plus years. About 65% of income is linked to inflation within that portfolio. And a similar story on real assets and private debt strategy.
Fantastic. Well, I'll let you get on and we'll move over to you again. Thank you.
Thank you, Paul. Great questions. Thanks a lot. So I thought it would be useful for us to have a look what evolution has been within the portfolio, what progress has been made, given that we've been managing this portfolio for nearly 3 years now, and there were a few changes made within the portfolio and more to come. One aspect that I spent quite a bit of time initially was how the portfolio is constructed from the risk management perspective, from the asset class exposure and risk return characteristics. And initially, the portfolio had quite a concentrated exposure in real assets, predominantly in water rights. Now, I really like this asset class. I think it's one of those asset classes that has strong diversification benefits. When we look at correlation to most asset classes, it would have negative correlation. So very, I would say, esoteric asset class for many investors. Takes time to really get comfort with this and to understand how it works. Still, to me, it was a concentration risk within the portfolio. So what I did last year, I started reducing exposure to water rights. We currently have about 22% in that asset class, which is then split between water rights fund, and some percentage of that is associated with an agriculture asset within Strategic Australian Agriculture Fund. In other words, over time, you would see that this allocation will be further decreasing. Long term, I do expect to have about 10 to 15% in water rights within the portfolio. It's a great asset class to have. It does deliver a combination of capital growth and income return. In the past few years, capital growth has been the one driving the total return. In fact, when we look at the valuation of the water entitlements in Australia, it's still at historically high level. The income component of the return is the one that can be quite volatile because it's very correlated to weather conditions. So when we do see increasing rainfall, that means it will impact the income return from the water rights. As we enter dry season now, and the expectation is it will be for the next 12 to 18 months, we may expect that income return from water rights will start improving again. So that was one change, one of the first changes that I made within the portfolio. And what I did as well, I diversified further that core income producing part of the portfolio by adding infrastructure, healthcare real estate, and private debt. So when we look now at this, foundation of WMA portfolio, you'd see a well-diversified risk-return profile of that income component. We introduced a new asset class, private debt. I'd be happy to take any questions on private debt. I usually do get quite a lot on that. To me, it's the portfolio that can provide some, interesting opportunity given the current interest rate environment. And to give you a sense, last year, the same strategy where we invested had a running yield of just over 4%. This year, this running yield is over 8%. Now, the difference between the strategy where WMA invested versus some other that you might see in the market is that it's all in senior loans, very, plain vanilla private debt strategy, mature portfolio of over 33 loans, all floating, and the loans are to mature, large, cash-generative businesses. So quite different what I see right now in terms of the new offerings to investors. And then within private equity, there were some changes as well. We've been exiting maturing investments that we inherited in this asset class. And I've been investing or recycling this capital with new investment partners across various strategies. So to me, it's about, again, focus on quality, focus on the groups that, on the investment teams that I know well, and focus on the track record, on the realized track record that they've delivered to their investors. The strategies we have within that part of the portfolio include mid-market buyout. It includes turnaround, transformation, and growth. One of them within growth, it's more of a mid-market growth, Crescent Capital. I really like their focus on healthcare. So they are one of the very few players in Australian private equity market who have very long track record in healthcare sector. So as the question already was answered on the level of cash. Now, what you can expect to see over the next 12 to 18 months is that the cash level will continue going up and down. And that's because we still have some inherited investments within private equity that we will be exiting over the next 12 to 18 months. And the dynamic or the timing of the deployment of this capital in alternatives is quite different versus other asset classes. In other words, if I commit today to a private equity strategy, it doesn't mean that this capital will be deployed tomorrow. It usually does take time to deploy the capital. One of the ways I have been doing to improve or to increase the speed of capital deployment within the portfolio is to get access to co-investments with our existing investment partners. So that definitely does help with the capital deployment. And then just like to run through the numbers, so about 43% of the portfolio has been recycled into new opportunities. On the back of the exits that we saw within the portfolio, and most of the exits were done at premium to carrying value, we've been growing the profit reserve. When I started managing the portfolio, the profit reserve was nearly depleted. So since then, we've grown the profit reserve to the level that gives us about 3.6 years of dividend coverage. The board has also increased the dividends, the interim dividends from 2 cents to 2.5 cents. I haven't seen their decision on the final dividend, but usually the way Wilson Asset Management approaches this is basically growing the profit reserve, building up this certainty in terms of the years of coverage for dividends. And then the board assesses whether it is reasonable to continue increasing the dividends. And based on the exits in the portfolio and on the performance of the underlying assets, underlying investments, the actual performance of the investment portfolio has been quite strong over that period. So it's about 12.3% per annum since inception, since we started managing the portfolio. What's been very important for us since we took over the management rights was to continue growing our shareholder base. And we've been successfully doing it since inception. The portfolio has been trading at a fairly stable share price last year and beginning of this year. And the discount that we had at that time was about 10%, 10 to 12%. Now, with the current market environment, I did see that the share price was affected, and that was driven, by various factors. But in general, that's what you'd see across the league market in Australia, that the discounts have widened. So the current discount for WMA ranges at about 18% to NTA. Now, this is the current composition of the portfolio, and I split here the allocation between the total portfolio exposure and the capital committed. From my perspective, it's really good timing to have capital that's been committed but not deployed yet, because this year we really started to see valuations adjusting across asset classes, private equity, real estate, infrastructure, etc. So usually when we look at the historical data globally for asset classes like private equity, the best performing vintage within that asset class has been the one that's followed challenging economic environment. So generally, it's a lot about entry valuations, not everything, but a lot about entry valuations, and assessing those opportunities now is much more interesting than last year, where we haven't really seen any moves on that front. I would also note here, you will see we have exposure to venture capital within the portfolio. This is inherited exposure within the portfolio. I'm not planning to invest more capital in venture capital going forward. I do see this asset class as quite risky, but also probably the one from all in alternatives that has the highest equity beta. So if my goal and my focus is on providing diversification benefits to our shareholders, that's the asset class that doesn't have a good fit within the portfolio. And this is to illustrate one of my points when we were talking about complementary benefits of WMA within an investment portfolio. So you'd see what is the volatility of the investment performance within WMA, and it's about 3.3%, and then volatility of the broader equity market and volatility of the total shareholder return, which is higher. So for many of our shareholders, it's really the only opportunity or the only access point to the asset classes that would behave differently compared to more traditional asset classes. And I will pause here for questions, Paul.
Okay, well, you requested a question on private debt, and I shall deliver. Is distressed debt part of your strategy for private debt?
No.
That's a quick answer.
No, it's not. I know it's, and I see it in the market. There are quite a few offerings or specific deals that are focused on this type of strategy within private debt. From my perspective, like, private debt is an asset class that has limited upside, but quite a significant downside risk. So when I think about the role of this asset class within WMA portfolio, it's more about the income return and about the yield I don't expect significant upside, and therefore I'm not prepared to take significant downside associated with this. So that's just one thing to keep in mind when, you know, investors look at this type of strategies. It's also this understanding, you know, yes, the target returns might be attractive, but what about the risks associated with that? And, you know, private debt, like if we compare private debt versus private equity, in private equity, you'd usually focus on the upside because the downside risks are usually better managed. Within private debt, the downside risks, in particular in those, you know, quite high risk type of deals, it can be quite a significant downside.
Yeah, got you. Another question for you. You touched on the first part of the question, not the second part. So I'll start from the top. Is there an asset class, sub-asset class that has you most excited of the potential for dynamic growth when the eventual exit is due? And can you give examples of underlying holdings in the presentation?
Yes, absolutely. So I do have a few slides in the next section on the underlying holdings. There are some really exciting deals that are happening right now and that have been closed. In terms of the opportunities where I'm most excited in the current market environment, you know, it's private equity. There's been very, how shall I say it, like very cautious approach to private equity deals. And to be honest, if we look at the transactional activities last year and beginning of this year, it's been very slow, and you wouldn't see many deals being closed in the Australian market and globally as well. Right now, it's really like an opening window for private equity across strategies. So Australia is quite a small market. You know, realistically, if we talk about high quality institution type of players in this market segment, we are talking about a dozen names. So the comments on the market would be a bit more global because that can give a fuller picture. If we look at the transactions for the first half of this year, about 80% of the volume has been in public to private type of transaction. So you may see this asset class that as very flexible in terms of the access point to the deals. And they do look at the relative valuations compared to other traditional asset classes. When those opportunities arise, you do see increasing activity. So this year, 80% of the total deals globally, public to private. In a normal year, it's usually 20% only. So just to give you the sense of what's happening in this asset class. But also, if you look at the broader picture, what's happening in the economy, what's happening with the business sentiment, etc., there are more opportunities now within private equity in strategies such as corporate carve-outs, corporate restructure, turnaround transformation, because larger organizations, they will be looking at ways how to improve their operational efficiencies. They do tend to focus more on their core businesses during those times. And so given that there is already private capital available, I mean, given the size of the dry powder in Australia, this will be a really interesting year for the asset class. Having said that, I think infrastructure, we will see more deals in infrastructure as well. Maybe not specifically in Australia, but markets like the US and Europe, we're likely to see more deals in infrastructure. And then within sectors, technology, in particular AI, software, cybersecurity, has been getting a lot of attention. Again, for the global deals within private equity, about 50% of those deals, they were within those sectors.
Wow. That's impressive. Actually, a question from me here, Dania, and you touched on this earlier, and I get asked this question a lot, and it's with the licks and the discounts to NTA. People, struggle to understand why they trade at a discount. And you also said that these discounts are widening. Can you just elaborate a bit more on why we have these discounts and why they're currently they're widening at present?
Look, as I said, combination of factors. So one, generally that month in June, like end of May, June, we do see this happening. And, if we have financial planners in our audience today, they will say a lot of this is due to tax loss payments. So that's been happening as a factor. The market sentiment played a big role here as well. And I think mostly due to the fact that many market participants, they were expecting that RBA will stop with interest rates rises. And at the last meeting, they continued, sorry, not at the last one, at the previous one, they still decided that it's appropriate to keep increasing the interest rates. However, the meeting that happened yesterday showed us that even like RBA wants to see what's happening with the market, and very likely they want to see the June quarter's numbers just to make this assessment whether that monetary tightening had an effect on the economy. So at the moment, quite a lot of uncertainty across those macroeconomic factors, plus more traditional asset classes that probably experience more significant drawdown than expected, and that put pressure, liquidity pressure on investors. So combination of those factors, and we saw the discounts widening across the league sector. And in general, the audience would know that that's basically what the investors in Australia have experienced. Not something that's happening for the first time.
Yeah.
From the WMA perspective, so I did get questions in terms of, does it mean, there are some major concerns within the WMA portfolio? The answer is, look, we go through valuation assessments on the underlying investments every 6 months. We are just starting now the valuation assessments for this financial year. And, based on the information I have, I don't expect like any, major surprises on the portfolio. So, it's well positioned, well diversified across strategies, across asset classes.
Fantastic. I've got some more questions. I'll save those at the end. I'll let you carry on with the presentation.
Okay, thank you. And I'm watching the time as well. So look, this section is really more focused on who are the new investment partners, how we work with them, and then a couple of examples. So within infrastructure, I invested with Palisade, and I've known Palisade for a long time, have invested with them before. Really, for the Australian market, their portfolio is one of the most established ones, and the one that provides a good level of access to different sectors. They also tend to operate more within the mid-market. So they're not really competing for any new deals with large global asset owners or large global players, which usually does tend to drive the valuations up when the global players come in. And with Palisade, I invested 20 million in their flagship strategy, Diversified Infrastructure Fund, and also acquired secondary units in their renewable energy portfolio. What I'd say on all of them, on all of the investment partners, WMA invests with them on terms that are offered to institutional investors. That's very important to me because I like seeing good alignment with investors. And as I mentioned before, on On the core side, Barwon was another addition. So we invested in their institutional healthcare real estate portfolio. The capital is still being deployed, so we're not fully deployed with them. And then the rest was in growth. Adamantium Capital, its mid-market buyout strategy. Allegro focuses on turnaround, special situation, transformation. If you did see a few articles in the media over the last few days, Allegro name comes up quite often. So one of the latest deals that they are looking at is the corporate carve-out in PwC. And then Crescent Capital is the one that I mentioned. I really like them in terms of their focus on healthcare sector, but also in terms of their strategy and operating in mid-market growth. One interesting one in growth part of the portfolio was Centennial. And with them, we invested in the JV that they formed with KKR to basically build a portfolio of last mile logistic assets. I included in growth because it's more of a redevelopment strategy, shorter investment horizon, and more focus on capital growth rather than income. And then the ICG is the senior loan fund where I invested in. It's Intermediate Capital Group, global alternative asset manager that's been operating in Australia since 2016. And they were one of the first ones coming to the market and offering institutional investors this type of strategy. So a few examples that I wanted to give you within Allegro. Some more recent deals include GAL. GAL is low cost. GAL is the business that operates low cost petrol stations in New Zealand. The thesis there was really improving operational efficiencies, but also preparing the business to transform into more of an electric charging opportunities and preparing the business to work well with this underlying theme of energy transition. And then the most recent one was Slater and Gordon. That was the public to private transaction where they acquired the majority equity in a law firm that was listed. Within Adamantium, we've been actively deploying our committed capital as well. And few examples, some of them you might know, I'm sure most of you would know Retail Zoo. Climate Friendly was a very interesting deal. It's basically one of the most established businesses in Australia that produce and accumulate carbon credits. Nog Hair is organic hair care products business, and Advara Heart Care is one of the leading cardiology businesses in Australia with over 90 clinics across different states. And then on the core part of the portfolio, I thought I'll give examples within real assets. So we talked briefly about water rights. It's one of the oldest portfolios in Australia in water rights. The investment team at Argyle has been investing in this asset class since 2010. I have a lot of experience investing with them in the past as well. And then within agriculture, we have exposure to a couple of assets there. One of the largest ones is Nerrican Citrus in New South Wales. Palisade portfolio, again, includes over 22 different assets across sectors. Some of the ones that you might know, Sunshine Coast Airport, number of wind farms, solar farms, and they continue pursuing opportunities across different sectors. They have a very interesting way of constructing the portfolio and focus more on building out their platform. So let's say within airports, they built a platform of regional airports. Within social infrastructure, they built a platform of specific social infrastructure. And the standout with them is also a differentiator with Palisade is that they have their in-house asset management team, which is very rare, but very important in infrastructure because a lot of focus should be placed on the operational side of this type of businesses. Sorry if it was a bit rushed. I'm just going to pause and hopefully we have time for a few more questions.
We have plenty of time for questions, Dania. So one here, given the current state of the economy, both globally, locally and globally, how does the rising inflation criteria, affect your portfolio?
Sure. Yeah, good question. Look, it will require to break it down again, asset class by asset class. So let's say if we talk about infrastructure, it basically, usually when interest rates are rising, you'd expect valuations in infrastructure declining. At the same time, given the nature of the contractual revenues within the infrastructure and the linkage to inflation, the infrastructure valuation has a different relationship with increasing valuation. So these two factors, they create this offsetting impact. I'm not saying that the current environment will have no impact on infrastructure valuations, definitely not. It all depends really where we will go with interest rates and inflation. If we go back sooner to low inflation, low interest rates, we can expect a bounce back in infrastructure valuation. If the interest rates continue rising, it is more likely that it will affect the valuations within infrastructure. So it comes down to the question, do investors have available capital to deploy into this asset class, because entry point would be quite attractive compared to historical levels. To me, when I think about valuation, it's a question about how do I construct the portfolio where I can bring this protection against rising inflation. Obviously, unreasonable to expect that I'll have 100% hedge in terms of inflation and interest rates within the portfolio. But bringing those components definitely helps when I think about long-term investment returns within WMA. Very similar with interest rates. Private debt, in particular, this plain vanilla strategy can serve really well as protection against rising interest rates. Otherwise, what we'd see in private markets or in alternative asset classes is very likely further adjustment in terms of the valuations. That's, it's out of the question. Even the ones like if we look at real estate, industrial last mile logistics has been the strongest performing sector for a number of years. This year, we already start seeing cap rates expanding, but we're not talking about cap rates expanding by 100 points, 200 points. No, like they will be expanding by 25, 50 basis points.
Gotcha. And final question here. What sort of pipeline in terms of opportunities can you see coming over the next year or two?
Pipeline, look, we are getting quite a lot of co-investment opportunities in private equity. So again, an asset class where we'll be active for WMA. In terms of, accessing something like real assets or like outside infrastructure, outside real estate, it will be more of an opportunistic play for us. Also because from the portfolio construction point of view, we already have quite a high exposure to real assets. So for me, it will be more around the timing, question around the timing. I will need first to exit the inherited assets within agriculture, and then potentially start looking at new opportunities. But in the meantime, looking at the market, there are some very exciting strategies like within real assets. one of the new additions in Australia is fishing rights. It's basically a new asset class, and I think it will have a lot of potential going forward. So I've been monitoring few new strategies and like looking how they're performing.
One for me to do a bit more homework, the fishing rights. I shall go. Dania, many thanks for your time today. It's been an absolute pleasure, and I wish you a great afternoon.
You're welcome. Thank you very much for the questions.
Thank you. And thanks everybody for tuning in today. And again, really appreciate putting in the questions today, and wish everyone a great afternoon. Thank you.
Bye.
Bye-bye.